Hello. We have a special guest today on this edition of Financial Perspectives. His name is Dave Butler. Dave is the co-CEO of Dimensional Fund Advisors based in Austin, Texas. Dave's been the co-CEO since 2017. Foster Group has worked with Dimensional. They are a provider of mutual funds, investment research, and consulting. And we've worked with Dimensional for almost 2 decades now. And they've become really an important, I'll call them a partner, even though there's no financial interest between Foster Group and Dimensional, but they've partnered with us and helped our firm grow in ways that we really appreciate. So we're very thankful to have Dave with us today. Dave, thanks for being with us today. We're looking forward to a good conversation about Dimensional, your firm, and all the things you've been doing for investors through the years.
Thank you, Ken. Appreciate it. And really happy to be here.
All right. Well, let's start off with your background. You've had an interesting one. I did some reading, and you've talked about it a little bit in the past, starting with college basketball, a little professional basketball, and then on to Wall Street before Dimensional. It's kind of an interesting path to get there. Tell us a little bit about that path. How did you end up from kind of a star basketball player to now leading a big organization like Dimensional?
Yeah, well, a lot of fun. It was an interesting navigation through those time periods. But I'm a tall guy, so if people can't see me, I'm about 6'9". And when you're 6'9", you naturally kind of gravitate towards basketball. So that was what I did, and had the opportunity to play college basketball, and ended up going to Berkeley, University of California. Played 5 years there. Hurt my knee 1 year. Redshirted, and I was able to play my 5th year as a grad student, so I was able to start my MBA there as well. At the end of my career, I got drafted by the Celtics, so I had a chance to go to the NBA. They had a strike the year I came out, so that didn't happen, and I got a phone call from a team in Istanbul, Turkey, and I ended up going over to Istanbul and playing my first year there. Then played a second year in Tokyo, Japan, actually in Yokohama, Japan, just right outside of Tokyo. Then came back and decided to finish up my MBA at Berkeley, and did that, and then got my first job in New York on Wall Street as one of the big investment banks. So kind of a bit of a kind of winding path, if you will, to where I am now. But like everybody's story, I was kind of a lot of starts and stops along the way.
Yeah. I was reading about your basketball background. One of the things that at 6'9", you're obviously a pretty tall guy, but then I read you've got a brother wup 7 feet tall. Yeah, so you weren't even the tallest guy in your own house.
Yeah, I was a little guy in the family. Yeah, exactly. He's a 7-footer. He ended up playing at Stanford, and then he got drafted by the New York Knicks, played 2 years with the Knicks, a year with the Clippers. We end up actually playing against each other. So Cal and Stanford are big rivals in college sports, and we end up guarding each other. We played the same position, so we guarded each other for 2 years there in that rivalry, which was a lot of fun. So the running joke in the family was my mom would wear her Stanford sweatshirt, my dad would wear a Cal jacket, and they'd sit in the stands and kind of be neutral on who they were rooting for.
Oh, man, that would had to be. I mean, I just got to. Is your family just tall? Are you all tall?
No, I think we're not. My older brother's 6'4", I'm 6'9", Greg's 7 foot. Then I've got a younger brother that's 6'3". So we've got height in the family, but I think it's my dad's mother was about 5'11", and she was born in 1900. So I think in those days, for a woman to be almost 6 feet tall was probably the height in the family, I would guess, and where we got it. But we all played basketball, and we played all the sports. And when you have 4 boys in the house, I mean, I'm sure your listeners with a lot of sons can understand it's always chaotic, and a lot of fights and a lot of wrestling matches and a lot of one-on-ones and, a lot of competition. So that was a fun way to grow up as a young kid.
Yeah, I bet so. Well, hey, if one of the things I know we talked about just last week when we were getting ready for this call is that your story, kind of how you got to Dimensional and really around who Dimensional is. I know one of the big stories really recently is Dimensional has produced kind of a film, or maybe Dimensional cooperated with a documentary producer, to have a film produced called Tuning Out the Noise, which really does a lot of explanation around how Dimensional came to be and how Dimensional thinks about investments. Tell us a little bit about that movie and kind of what we might want to expect if we see it.
Yeah. No, there's a lot of pride around Dimensional for folks at the firm. I've been here for 30 years, coming up in January of next year. So I've had a chance to watch the firm grow from about $9 billion under management to now $675 billion under management. So I've been able to watch this growth and the growth of the firm, and it's been really impressive, and been happy to be along for that ride as well. We have a gentleman that's also been here 30 years, a guy named Robert Dinsner, who I kind of consider our historian at Dimensional. And he also is a big film buff, and one of his favorite producer directors is a guy named Errol Morris, who happens to be a Nobel Prize winner, a Academy Award winner for a film called Fog of War. And that was the description of Robert McNamara's description of the Vietnam War and kind of U.S.'s involvement and so forth. So we got an Academy Award for that. Great producer. Robert actually ended up sending an email to Errol and basically started describing this kind of evolution in asset management and capital markets, particularly the 1960s, when data became available, and academics at Chicago and other universities started looking at data and trying to understand more about the markets, and that really led to this kind of evolution and introduction of index funds. And so this story is one of the people really that were involved in this kind of massive movement that we've all seen over time to a more passive index-oriented capital market exposure for clients, and then also the independent advice that kind of came out of that movement as well. So it's a story built around characters. It really takes us from the 1960s all the way up to today. I saw an article last week saying that index funds or passively managed funds now are over half the market. So, something like 51% of the market now is in index type funds. And I think that was about 3 or 4% when I started 30 years ago. So clearly there's been a lot of data and a lot of momentum around this movement towards away from active management towards more passively or index managed type portfolios. And Dimensional obviously is a big part of that story. When you look at the roster of people that have been involved at Dimensional, and I mentioned Nobel Prizes, we've had 5 Nobel Prize winners involved with the firm over the last 40 years, which is pretty impressive. And those folks are really the ones that stepped back and said, let's look at the data, let's look at the returns from the market, what an individual investor should get from the market. And then find out whether the funds that were out there, the actively management funds, were delivering on that investment return. It turns out they weren't. And a lot of the data and research that came out in the 60s suggested just that. And that was sort of the impetus for starting index funds in the early 1970s. And Dimensional's founders were all of the folks that were actually involved in the first launch of index funds. And as you know, Dimensional then was started in 1981. And that was really the story of trying to make the initial index funds that were started in the 70s better. How do you implement better on a daily basis? How do you target certain risk dimensions that are going to give you higher returns? So Dimensional is sort of this boutique outcome from this basis of foundation of kind of an index type viewpoint on the markets. And like I said, all the characters in this film really are the ones that have developed that story and really have made a great offering for individual clients, all the clients that work at Foster Group who use Dimensional funds. It's a really significant outcome for them in terms of their retirements and well-being and so forth. So happy to be part of that. And the story in the movie is one that I think just brings it to life in a way that maybe is more digestible for the average person that's not a finance major. It's really built around personalities and stories and backgrounds on people that then Errol Morris ties into this overall story of how we got to where we are today in terms of how people index and how they invest their money on a go-forward basis.
Yeah. Well, the title is interesting. I think the title is Tuning Out the Noise. Is that the title of the documentary? So
yeah, it's Tune Out the Noise. Yep.
Tune Out the Noise. So comment a little bit on why that title.
Yeah, I think it's funny because Errol Morris, again, he's not a finance person. He's a storyteller. He's a director, producer. And he literally took 70 hours worth of interviews across 23 different people that were involved in some way with Dimensional. And he narrowed down kind of what he thought were the themes. And one of the big themes in his mind was this concept of tuning out the noise, in the sense that for all of us as investors, there's a lot of noise. There's social media and there's TV and radio and ads and experts out there that are going to tell you that they will find something better. They'll be able to beat the market in some way. They'll be able to find the right stock. And what we've always found here at Dimensional is that if you're able to, quote unquote, tune out the noise and remove all of that stuff from your kind of investment life and your investment journey, you're going to be much, much better off. So it was interesting that Errol Morris, again, as a non-finance person, after listening to all these interviews and so forth, that he came out with that name or that title as really probably one of the big themes that he picked up from this whole thing. And so he, along the way, I think he became an investor and his producer became an investor. All the people that sat and listened to these folks tell the story, they all became investors in the funds. And I think that's been, that's one of kind of the fun parts of that whole story, is that these folks who had never really heard the story became very, very engaged in it, very interested. And they asked the question, why hasn't this story been heard more? Why do more people not know about this approach to investing? And that was really Errol Morris's kind of aha moment, if you will. And when Robert Binsner, our employee here at Dimensional, sent that email, he assumed that Errol wouldn't send anything back, would just kind of go into junk mail, whatever. But he said Errol called back or emailed back in like 30 minutes and said, I love the idea. I love the concept of the story. I want to hear more. And as he started to roll up his sleeves and heard more about the story, he just thought this was a really significant story that had to be told. So that's the movie, and that's what I think your listeners will find very interesting. It's a good story to sit back on the couch, grab some popcorn, and a glass of wine with your spouse, and listen as a story as a good movie would do for you.
Yeah, I love that. The tune out the noise is a message that we at Foster Group just agree with 100%, because there is so much noise, so many things competing for people's attention, kind of telling them a story that may be based on maybe a fear kind of promotion or maybe a greed kind of idea, and trying to really appeal to the emotions of an individual investor and get them to do something that may not be in their best interest, but it's a way to get some motion as opposed to maybe doing the best thing for them. So that's been kind of a theme I know at Dimensional for years, and it certainly is a theme that we've resonated with it well here at Foster Group. So
yeah, I think that's right. Yeah. I think that, the industry has been built on emotion, and it's been built on fear and greed and our reaction to that emotion. And our reaction is usually that we trade, we transact, we do something. And the reality is all of that action and those frictions are not good for you as an end investor. So tuning out the noise and, trying to reach for calm, trying to be a different type of investor, I think is really, really important to having success. And just as a comment to that, I think the reason why Dimensional works with advisors in the form that we do is I think we think that advisor is really the coach and somebody who's a voice of reason, a voice of kind of a rational voice that I think is really, really helpful for any investor along the journey, just to have a backstop. And clearly advisors do a lot more. They do all of the other wealth management facets that are important, but there's also that aspect of discipline that I think is important. I have an advisor myself. And people always ask, do you have an advisor? And you've been in the business for 30 years. Why would you have an advisor? And my advisor is just that. He's a counselor. He's a coach. He's a confidant. He provides all of that for me, and it makes my investment journey much, much smoother. And a really important part of my financial experience, and also for my family, which is the most important part, is just knowing that there's a person at the other end that, I've got 4 kids now, and having that person be part of the family really, if I'm not here for, God forbid, I'd be very, very confident having my family, having this person as a caretaker for the family in a really important way.
Yeah, that's important. I know for a lot of people, we hear that regularly. I have the same arrangement. I have an advisor who I work with, and my wife and I, and it's just super important. Hey, so hopefully we'll be able to provide a link to our listeners for that movie at some point here in the near future. So if you're watching or listening, look for that link. We'll get it to you. But we're looking forward to seeing the film. So thanks for sharing that with us. Hey, one of the things we talked about recently was an investment experience that you had. And so this is kind of turning the corner into talking about investors and investment experiences. One of the ones that you shared with me was one that maybe didn't go quite so well. It had something to do with chicken in the state of Massachusetts, I think. So, maybe you can kind of tell us that maybe that one of those initial investment stories you had personally that made you consider other ways to think about investing.
Yeah, no, it's funny you bring that up. Every investor has a navigated path to get to some solution, some answer. I'm a different type of investor today than I was 30 years ago. But if you look back at my career, as I mentioned, I did my MBA at Berkeley, and all my finance classes were built around discounted cash flows and looking at financial statements and trying to determine whether a stock was undervalued or overvalued. So I thought that was really what finance was about. And when I took my first job in New York at one of the big investment banks, I decided I would utilize those skills to make money in the stock market. And I had a stockbroker, a guy named Tom, that would regularly call me and feed me different stock ideas. And I, with my background, I felt I could take those stock ideas, and I had a system. It was called CAN-SLIM. The acronym was CAN-SLIM, and it was, C was for current earnings, and M was for momentum, and I was for institutional ownership, and so forth, so on. So I would use this model, this CAN-SLIM model, and I would look at these stocks, and then I would make a decision as to whether I would buy or sell. And in that last year in New York, before coming across Dimensional, I had a great start. I was 7-0. I'd won 7 times. I'd actually made money on all 7 stock picks I had up to that point. So I thought I was, pretty good, something special. And then I had this opportunity to buy this stock called Boston Chicken, which I think became Boston Market over time. And, some of your listeners might remember that name. But Boston Chicken was trading at 16. The all-star analyst at the investment bank I was at said it was going to trade at 23. Once the earnings came out the following week, I did all my CAN-SLIM work, thought for sure it was a $20+ stock. And so I took about 75% of my net worth and put it into this stock. Ooh. And of course, when the earnings came out, the earnings didn't hit where the analysts thought they were. The stock went down to 6. I was actually in Utah at the time on a business trip, and there wasn't, social media, there wasn't internet and so forth. So I pulled out a Wall Street Journal, and I opened up the journal and saw the 6, and kind of my heart, kind of fell through to the ground. And then I noticed there was a crease in the paper, and I thought, well, if I just pull the crease apart, I'm sure there'll be a 1 inside there, so it'll be a 1.6. And of course, there wasn't. So I finally got a hold of my broker, and I said, Tom, what happened here? And Tom said, he says, just didn't work out the way we thought it would. I'm sorry. And so that experience was a really big one for me. Painful at the time, but important for me to recognize that this idea of investment advice being built around looking into the future and predicting the future. We used to like to say looking into the crystal ball and trying to figure out what was going to happen in the future. That wasn't a business that could be built into a really sustainable business. Having to say you're sorry often to your clients is not a sustainable business. So I kind of left that experience a little bit confused, a little bit dazed. Fortunately, 3 months later, I came across an ad in the Wall Street Journal, and it was an ad for Dimensional Fund Advisors. It was I was sent a resume in, and I just heard about a whole different story of how to invest, and so it was kind of really a blessing for me, I guess, in terms of having that kind of experience, because I probably wouldn't have had my eyes open to this type of opportunity or this type of investing if I hadn't had gone through that Boston Chicken type experience. So it's funny looking back at it at the time, very painful. And I know a lot of investors go through that same experience. So what I always like to tell people, it's like, most people become transformed at some point, but you just never know when that transformation is going to happen. And for me, that transformation happened with that Boston Chicken event. And then 3 months later, I heard a different story, and a story I thought would be one that I could be very sustainable for me as a career, and something I always say that I could look in the mirror and feel very confident, feel very positive about recommending to anybody else out there. And I always like to use my mom as an example. I'm happy to give this kind of story to my mom at any time.
Yeah. That's something about the price of education. Sometimes it's like how we pay for education varies. Sometimes we choose to pay it, and sometimes we pay it maybe unwillingly, but we still get the education.
Right.
That's sort of. I was sad to see Boston Market go under because I think I mentioned I had a friend of mine when I was living in North Carolina, and we would eat regularly. Like we'd meet once a week at Boston Chicken, then Boston Market. Because at what other fast food location can you get cream spinach? I'm not sure anybody wants that today, but I just remember this was kind of interesting. It was great.
It was really, really good food. I mean, that was the first kind of higher end fast food restaurant. The concept was great. The food was great, but obviously stock prices and earnings are different story.
Yeah. Isn't that true? Yeah. The stock price sometimes is not related necessarily to the business idea. That's a hard lesson to believe. So let's talk about risk for a minute, the kind of risks that investors face. You had one there, a good example of one. How do you think risks exist for investors today versus what those risks have been in the past? And then maybe along with that, how does Dimensional help investors to manage or to deal with that kind of risk?
Yeah, I think the risks are the same. I do think that given technology and given the internet and given the speed of information that we see today, I think the risk is actually elevated. And the ability to stay disciplined in your pursuit of certain investment returns, I think it becomes more challenging. So as you look at where we stand today, I think there's just so much more information out there, and we really haven't fully grasp or recognize the importance of what the capital markets are and what risk and return mean and how they're related. And sometimes when you see the nonsense that goes out about stocks or certain types of changes in the market, artificial intelligence or whatever it might be, that things are going to change and going to be different and you need to change your approach. It's not true. When you look back at people, you look back at returns specifically, the returns are there to be, they're there for the taking. If you have capital and you put that capital into the market, you're going to get a return associated with that capital. And most likely that return is going to be higher than one where there is no risk, like a fixed income or a T-bill type of a situation. So, I think it's important for advisors, particularly in clients, to have those conversations. I think it's important for them to understand that there are returns associated with investments into the capital market, but there's also great variation around those investment returns, and that investment return is not going to show up, year in and year out, or week in and week out. But I think if the advisor and the client are able to sit down, converse about the topic, make the proper expectations, set the expectations properly at the front end, then I think the ability to meet those expectations is very high, and the ability to have a long sustained relationship is very, very high as well. So there's a real difference between saying you're going to get a stock return of 20% versus you're going to get a stock return of 10%, and there's a variation, of volatility around that 10%. It's a pretty high variation. So let's expect and prepare for that, and let's build out your financial plan in a way that's going to recognize that there is variation year to year. So I think those kinds of conversations are very different, and I know those are the kind of conversations that Foster Group has and many of the other advisors we work with have with their clients. And it's not a conversation built around, hey, guess what? I got this new idea, and we're going to put a lot of money into that idea and hope for the best. Hoping for the best strategy is not a good strategy for the end investor. So, a much more stable, transformed, comfortable, confident journey, if you will, on the investment side is really, really important. And I think it's, again, hyper important that the advisor is involved in that along the way. It's just, no matter who it is, myself, we all have emotions. We all read the news. And as my old mentor, Dan Wheeler, used to say, God forbid I don't invest your money based upon my opinion. So we all have opinions, but you don't want to have those opinions involved with your actual investment process.
Yeah. I think about your two stories there. So there's that Boston Chicken, which is kind of it's an investment in a stock, but it's a very concentrated investment in one thing, one idea, creates kind of a lot of risk on that one. Yep. And then you were talking a lot about the capital markets. And I think that's been one of the real kind of breakthroughs in the way, even why there's index funds and things like that, is because people recognize, I can diversify the way that I experience risk, because the capital market as an entire market can provide return with just a tremendous level of diversification. So that one idiosyncratic, hey, if I put money on the wrong single thing, the risk just goes up, in a way that it doesn't need to for the investor. There's a possibility that it could home run it, but there's also a possibility it goes exactly the wrong direction. And that undiversified risk is, as you've said, from the academic side, it doesn't seem to be warranted in terms of a risk-adjusted return to try and take this, I'm going to try to pick a company for a particular time versus I'm going to sit with what, like Warren Buffett would say, I will take the tailwind of the U.S. market or the U.S. economy as a diversified investment, and that can work extremely well. And I think you guys have really just continue to make that clear through the research you do and how you work with advisors and investors both.
Yeah,
that's really a more
amazing.
high percentage way.
Mm-hmm. Yeah, it's amazing how the education system doesn't really recognize that. I mean, I spent 4 years of undergrad business school, 2 years of business, getting my master's, getting my MBA, and most of my classes were built around specific stocks and how to identify the stock versus that concept, diversification, and being important. And for me, it really took, my interview at Dimensional, my first interview, I mentioned this story to you as well. When I came out to Santa Monica, California to interview with Dimensional, one of the first people I met was a guy named Merton Miller. And Merton was a Nobel Prize winner in finance. And we actually happened to go to lunch. I got to go to lunch with Merton, my first interview at Dimensional. And I always say, I remember this day, he said 3 things. He said, markets work. He says, costs matter and diversification is your buddy. And he said, if you can keep those 3 things in your mind, you're going to be a great investor. And it's surprising to me that I was probably 35 years old, 36 years old at the time. And it took, that many years to get a clean, simple message like that for me to actually then understand it and recognize it and go, that is important. So those 3 concepts are really the basics, are kind of the bedrock for any investor. If you can do those 3 things well, then you're going to be better off than most of the investors out there, which I think is really, really important. Dimensional would say, we also go beyond that, and we do daily implementation, and we identify certain risk dimensions that we efficiently capture and so forth. So you can do a bit more than just those 3, but those 3 are really important for as a starting point for any investor.
Right. You don't want to lose sight of this. I appreciate the fact that a Nobel Prize winner can describe investing in a way that anyone can understand. I mean, that's really, a lot of academics can't do that. They're giving you formulas and all kinds of things that are just, I'm sure they're very interesting, but they're not as accessible. So it's great to hear, that someone who's had all the information, done all the work, has all the technical, he can say, at the end of the day, this is what the information tells us. I think that's just
I think that's really important. I mean, one of the lessons I've learned through both my athletic life and business life is just that, is simplicity and summary. And the more complication that somebody's able to understand, the better they're able to drive to a simple, summarized version of that complication. So every great business leader I've seen, every great coach, they've always narrowed it down to, hey, what are 3 things that we need to do to be really successful in basketball? What are the 3 things we really need to do to be able to be a great business firm? And sometimes people assume simplicity is not that impressive, but I always think the opposite. I think simplicity is very, very impressive because, to your point, when I've talked to the Nobel Prize winners that I have, Gene Fama is one of them, those guys know everything, and yet they're able to narrow in and summarize and describe something in very, very simple terms. And I think that's what is impressive, and I think that's what really allows great ideas to come about and come to fruition. So I think that's what's happened here in a lot of ways. I mean, we do pretty much a lot of the same things, but we do them in a really, really informed, efficient manner that I think people do appreciate over time.
Yeah. So that's great. A story about Merton. Another question I like to ask people is kind of this idea of, aside from your parents, who I know have huge influence in all of us, who else has had kind of a major influence on you, how you think about investing, business, whatever it might be. It's kind of always hard for me when I say who's had the most. It's always hard to pick out the one. So I'll say who's had significant influence that you would go, yeah, this person, because of who they are, what they've said, really has had kind of a lasting influence on you.
Yeah, I guess the guy that would come to my mind immediately is Dan Wheeler. And Dan is the guy that hired me at Dimensional 30 years ago. Dan is the guy that was the first independent financial advisor to work with Dimensional. Dan was the first advisor to use Dimensional funds with his clients. But Dan was this really, again, very, very smart person, had a great presence about him. When I first sent that resume in to Dimensional, I was sitting on the desk in New York, very confused about what I wanted to do. I thought I was going to go be a basketball coach and a teacher in high school. That was going to be my next move, because I thought finance just didn't make a lot of sense to me. I didn't see the right outcomes for the end client, and I didn't really see an out that would make me want to stay in the industry and feel good about what I'm doing. And so I sent that resume out, and I fortunately ran into this guy, Dan Wheeler. And I went up to the 11th floor in Santa Monica. Dan was there to greet me. He sat me down at his desk and kind of said some things that to this day resonate with me. And, one of them was just this idea of transparency about independent advice. And he described this great model of, the old model was the crystal ball model, always having to say you're sorry. And he said, no, we've got this new model of advice, and the model is built around independence, where there'd be this independent asset manager, in this case, Dimensional. And Dimensional was an expert in capital markets and capital market research, portfolio management, trading. And then there was this person called an independent advisor, who was the expert in the client experience, and they knew everything about the client. And he said, the combination of those two would be able to deliver the best client experience possible. And I'd never really thought about that in those terms. And Dan, again, was a very, very smart person, and he had been on the other side of this kind of finance advice question. And he said as a birthday present to himself, he left that world and became an independent advisor. So this idea of independence was really, really eye-opening for me. And when he described it, and he described what he was doing at Dimensional, that changed everything for me. I was like, it was kind of the aha moment. And I said, yeah, I can do this, and I can be proud of what I'm doing. I can feel good about what I'm doing. But it was interesting to just have this independence concept be so important to that outcome for the client. Foster's an independent advisor. Foster makes decisions on behalf of the client. They decide who they work with, whether it's Dimensional or somebody else. It's an independence there. There's no connection between Dimensional and Foster. So, that's an important aspect. And I think in the 80s, when I was first coming in the business, most of the models were very integrated. The asset manager built portfolios. They had employees who were advisors and sold those portfolios, and then they had the custody, and they had the platform where everything sat on. Those portfolios sat on the custody platform. So there was really an integration model that didn't allow for independence and didn't allow for transparency. And so Dan was really the first advisor out there that kind of said, nope, wait a minute, this is actually better for the client. Let's start with the client first, and not with the firms and trying to figure out what's best for the firms. Let's figure out what's best for the client. And his thought was that if clients had great experiences, then the advisor would also have success, because those clients would be happy. They would refer colleagues and friends to that advisor, and that advisor would grow in their own space. So advisor success and client success, I think, are really wrapped into one. And I think that's been, a true legacy for, again, not a name that anybody would know, but Dan Wheeler. I think all of us in this community know his name very, very well. He passed away about 9 months ago, back in February of last year. And just the amount of accolades and, thoughts and comments and prayers for him. It was just, really incredible. There's so many people that were really affected by this guy, Dan, and myself included, for sure.
Yeah, I know our two founders, Jerry Foster and Mark Statlander, they told stories about Dan as well, being very kind of influential for them, because that really is our model here, as you know. And I love that when I'm talking with a a client or investor and they say, well, what makes you pick, one investment over another? And say, well, we pick the investments that we think are best for you, the client. We're not receiving any compensation from any investment firm. And so, our interest is just to do what is best for you. And we as an advisor, it's really, I think, a position of strength and comfort to look at the investor and go, there's nothing going on here in my decision making other than I really want you to have a great experience. And we're going to try and do all we can to make sure that happens.
That's true.
That transparency is fantastic. So
and
we hear that from you guys all the time.
Yeah, it's a noble profession, I think. And Dan used to describe it. People often say fiduciary, meaning trust, the trusted position, but he used to talk about it as being sitting on the same side of the table as the client. In his old world, his view was, you sat on the opposite side of the table. I had my objectives, you had your objectives. And in this new model, he said the advisor would sit on the same side of the table and they would be working in the best interest of the client. And that was a real game changer in terms of what financial advice meant at that time. And clearly the model has worked out very, very well. The fiduciary sit on the right side of the table model has been the one that's massively grown over the last 20 years, and that's kind of what where Dimensional's been involved with has been in that space as well. The other part I think is just sort of in the education part. And when I think about Dimensional, we're a unique firm in terms of what we offer, and we talked a lot about indexing and passive management, but what Dimensional does is very, very different. There's a lot of subtleties in terms of kind of how we do daily implementation, how we think about reconstitution, how we think about different exclusions of stocks and so forth. And so for us, the ability for us to work with professional advisors and have really in-depth conversations and let them really kick the tires on us and understand, why would you use Dimensional versus a standard index fund? It's really up to us to be able to make that case to the advisor. And if the advisor buys into that case and that story, which I think they should, then they would propose that to their client. But that's an important aspect of the business as well. So people always say, well, how'd you get so big? You're almost 700 billion and you've never advertised before. And I think anybody in the audience would recognize if you do something well and you have people that would recommend you and refer you, you don't really have to advertise to have quote unquote business success. So I think that's what's happened for us. And hopefully we've, as I said earlier, we've set expectations and we've met those expectations. Hopefully Foster would agree that, over the 25 or 30 years that we've been working together, that we've met the expectations regularly. And that turns into this concept of trust. And trust is really what the whole relationship is about, whether it's advisor and Dimensional or Dimensional and the client or the advisor and client. It's all built around trust.
Exactly. Yeah. Remember another Nobel Prize winner, Bob Merton, when I was at one of your advanced conferences, he talked about the trust formula. For him, it was character plus competence equals trust. And, we added character plus competence plus care. It's kind of for us, when we think about our client relationship, that's really what we hope to bring to every client relationship, that they'll feel truly cared for in this kind of trusted relationship. If we can provide that, again, another Nobel Prize winner who can just talking about, hey, what really happens in the world of finance for the benefit of the client or the investor. It's this idea of trust, and how do you develop it? How do you warrant it? And how do you keep it? That's a big deal. I've been using a quote from David Booth, one of the founders of Dimensional. I love this idea of educated optimism is the antidote for, I think, anxiety, particularly as it relates to the market, or uncertain anxiety. And I just love that idea of educated optimism, because I think, again, you talk about education. If we look back at where we've been, how markets work, kind of where we are, there's a lot of reasons to be optimistic that markets will continue to provide reasonable returns for investors who understand kind of that risk return trade-off. So I'll just pose it to you, Dave. What makes you educated optimist about the future of markets and kind of investment experience?
Yeah. No, you summed it up. When you look at the long-term data, I mean, markets return about 10% for the last 100 years. We get caught up in the moment. We get caught up in the news. As one of my colleagues calls it, investment pornography that's out there. It's stuff that is really built to make us react. to some emotion, fear or greed. So if markets are great and we get excited about a certain area of the market, we're going to get the phone call to invest more in that part of the market. So the big technology stocks are doing well right now. So that becomes, okay, I think that's safe, but it's those kinds of concepts. You have to always just pull yourself back. You get to your investment policy statement, the one that's been built out over time, viewed properly, and working with a good coach, a good advisor, and if you can stay with that, we've got the tools, we've got the actual portfolios that are cost effective and tax efficient and diversified. So we've got all that. The big problem we have often is sometimes the emotion that is attached to those portfolios. So again, that's where the advisor comes in. It's usually, as one advisor told me one time, it's usually not people with portfolio problems. It's portfolios with people problems. So that I've always liked that, and I think that's true. So we can do all we can on our end. You can do all you can on your end. But this at some point, the client has to become quote unquote transformed, and they have to be relaxed, and they have to understand that in an optimistic way that there's a return associated with offering your capital into the capital markets, and looking at long-term returns and long-term histories, I think is a great way to actually get comfort in that. Because if we're acting and looking at just short-term views and daily movements of stock prices and so forth, we're always going to have a reaction that's probably not going to be helpful. My one of my advisors also said at one time, he said, if you look at most people's best investment in their life, and we just talked about this the other day, Kent, is their home. And that's a lot of cases because the home is very stable and people have families and they don't want to move. And we don't have anybody coming on the TV or on the radio saying, hey, your home just dropped 1.5% in value yesterday. We don't hear that. And so what that puts us in is a position where people like my parents, I'm sure you and my parents have been in the same home for 50 years. And they always say, this is the best investment we've ever had. And partly it's because they haven't had any noise. They've tuned out the noise, if you will. Yeah. There isn't noise around the stock, around the real estate market like your personal home. So anything that we can do to kind of minimize the noise, I think, tune out the noise, if you will, is going to be very, very helpful to your long-term returns. And if you look at compound returns over time, they can be massive if you just leave the portfolio and place them where it is. So it's an important concept that people usually don't pick up until somewhere later in life. So the earlier we can get to that, I think the better off most investors will be.
Yeah, again, it's that education. The educated optimism is the great antidote for kind of this anxious uncertainty. Because the world we live in is uncertainty. It's full of uncertainty. There's going to be surprises in the short term. Certainly this year, we're in a political year. There's always lots of uncertainty about what's going to happen. But I think that education, kind of looking at how things have worked, thinking about the way markets work, just the incentives in the system. I mean, there's a lot of reasons to be optimistic about the future. I know that we try to continue to share that with people who, are listening to us or clients of ours. And we appreciate that you guys are doing the same thing. And just again, appreciate your time today with us. Appreciate the relationship with Dimensional and all the work that you and the kind of the professional, the Nobel Prize winners, the researchers who have been working along with you for so many years. I think a lot of investors have benefited from that. So thanks for your contributions, and we look forward to many years of continued relationship with your firm.
Thank you, Kent. Best to all your investors, and as we say, tune out the noise and stay confident in the outcomes that you should expect.
That's right. Great. All right. Thanks, Dave. Have a great day.
Okay. Thanks. See you, Kent.
Hey, thanks for joining me today in my conversation with Dave Butler here on Financial Perspectives. I've known Dave for a number of years, as I mentioned. I think he's a fascinating guy with some great stories. I hope you thought so too. We're hoping to interview some more people like Dave over the course of the year, so look for those episodes as they come out. But until then, thanks for watching today, and we'll look forward to seeing you the next time.